Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market using the tools available on StockCharts. We'll look for long time frame trades. Please subscribe to my articles and Twitter feed. So the market seems to want to open up and down 130 points every day just to keep us guessing. I think one of the questions I have is it hasn't really done much after the open, so it kind of all happens in the after hours and then just kind of treads water. So continuing to be concerned about the level of momentum, but still got to trade this market. So, and I forgot to change that. I'm sorry. This is August 21st. My mistake. We've moved the calendar or the date over to the right hand side, and I missed that. So we're going to talk a little bit about the Church of What's Working Now. That's a Mark Haynes phrase from CNBC. He'd have somebody on the show and they'd talk about what was working today, and he'd just call it the Church of What's Working Now. So we're going to cover that off a little bit, and obviously oil stocks are not working. So we're going to cover that off too, because they're at an interesting place. Most of them have broken below support, but they've been spending 3 weeks just kind of going sideways. Now the real question is, can they make the next move higher? And we'll look at that. And bonds, I want to talk about a little bit. On my weekend show, I usually show a slide of the corporate bond index, and on there's a note that says PJT, Paul Tudor Jones, PTJ, says that this will be the next place for a big problem. And what he's referring to is the corporate bond yield is so low right now that if we have any sort of price increase or bond yield increase, the price of these bonds will fall. And as an example, a 2% move would be 50%, and that's from Jim Bianco at Bianco Research. So all of a sudden you have institutional investors or retail investors in these bonds, and literally a 2% move has them lose 50% of their money. So you want to see people start to fly out of something, they'll be moving out of a bond market very, very quickly when that happens. And so this situation that we're in with bond yields continuing to go negative. Germany just released a 30-year bond with zero interest, and it was unsubscribed or sorry, undersubscribed. So they were trying to get 2 billion, I think, and they only got 842 million. But still, 842 million for a bond yielding zero seems remarkable to me. But the bet is that the interest rates continue to go lower and these bonds actually become worth something more than just zero. And so if the Fed lowers interest rates and everybody's going down this path of lower interest rates, we all think it's just crazy, and I'm sure economists never forecasted 14 trillion in negative yields. But all of this is adding up to be a very, very bizarre environment. And so one of the big beliefs is when everybody leaves bonds, they'll come rushing to the equity market. The other thing is when the bond market blows up, then perhaps everybody will just run from everything and wait until the dust settles. So there really are two different camps. But right now it seems, I think they said in January there was no negative corporate bond yields. I might have that wrong. Maybe it was 200 million, and now it's already $1 trillion. So it's literally accelerating at such a rate that nobody can keep up. Okay, so this chart here, and it's very simple, but I've each one of these panels is narrow because I've got quite a few panels on the page, but these are basically some of the top tech names and large caps that have been performing. And so if we look here, just zoomed in, this is Amazon, and you could just see it's holding this lower red trend line. It's sitting barely above its 200-day moving average, and yet we're just sitting in this zone here with no real momentum higher. This is Apple, and what we see on Apple, of course, is it continues to try and break out of this range. Looking horizontally, we can see how important that might be. They continue to buy back an astronomical number of shares. 75 billion is their buyback. So it's probably not going lower, but the real question is, does it have the power to go higher? So here we have Facebook, and we can see Facebook sitting right on this trend line, and I think we'd agree Amazon is sitting on its trend line. Looking at Alphabet, um, this trend line is holding up, really just going back to the May 31st low. And so looking horizontally across that chart, you can see we're not, I mean, percentage wise, we're up about whatever, 11% above the long-term support. But so far we have this double topping structure, and now we're trying to find out if we have any momentum to get this driving higher. Netflix clearly continuing to slide and getting close to support. And Microsoft continues to push up here, but not very far off its trend line. I've used this point and these 2 points here rather than this end point. If I use the end point, we'd have a more shallow line, say down here at 130 instead of 140. And then looking at Adobe, and the only reason I have Adobe in here is because it continues to perform, and it's sitting right on this trend line as well. So none of these charts are breaking out to new highs. Microsoft's very close. Apple, we noted earlier, is very close to trying to get through this recent high, 2019 highs, but still pulled down. It's got to go another $10 or $20 to get up to the late September highs. And Amazon, of course, 1,800 to 2,100. This range has been traded in for quite a while now, and we're still waiting to see if it's got any mojo to push it higher. The next part of the church of what's working now is the hot tech stocks that are rolling. And I wrote an article about Pinterest yesterday, and it looks like it wants to try and push higher. But if you look, here's PayPal, and you can see just trying to bounce off its 200-day moving average. Team, Atlassian Software, I think it is, looking very good here. The chart continues to trend higher, but really just trading sideways for the last 6 to 8 weeks. No real upward progress. I don't think anybody thinks Visa's going broke, and we're coming into the retail shopping season, so that line could probably extend higher pretty easily. Here's MasterCard, same issue, trying to break through to new 52-week highs, and who wouldn't be surprised that that chart makes higher highs. Shopify continues to astound, I think, probably everybody, 120 to 375 already. And then on the Canadian market, it's over $500 already. And it was only a year ago or so we were talking about that stock at around $100. MSI, we can see it up in the top right-hand corner. And ServiceNow, just after this pullback, grinding sideways here for the last 2 weeks, trying to see if it's got any momentum. But I think the big point I would like to make is this MSI looks good. Shopify continues to soar. I think the MasterCard and Visa obviously look good. My big perspective is everybody's crowding into this very small bucket. And I'm wondering to see how this is all going to play out. So when I mentioned the bond market earlier, this was one of the points I made, was that bonds and gold are moving together pretty closely, basically for the last year. And the real question is, if the bond move was over, does that make the gold move over? And I would just say that it's probably more important to be thinking about that than thinking about a continuation of the move. Now, again, the Fed is going to cut interest rates probably in September. I think there's 100% probability of that right now. And when we look across the bond market, I think the bigger problem that we're going to have is if the interest rates move rapidly the other way, don't have any particular reason for that to happen, but if the interest rates were to rise rapidly and price fall, then you'd have a massive dislocation of money moving away from the, quote, safety of bonds, and right now one of the better working trades this year, into something else or just into cash. And the real question is, would they run into the equity market if the bond market was having a severe dislocation? So I think that's one of the things to keep in mind, just if you're trading gold and you're watching the bond market thinking you're not involved at this point, I think they're tightly tied. This emerging markets, let's just switch the size here. What I want to show on this particular chart is that the emerging markets broke below support, and literally since it's done that, it hasn't broken down. It's just in a holding pattern here, and we've got a declining PPO that if it started to turn up, that might mean something. And there's a lot of expectation that the European Central Bank will go on a big monetary stimulus program. I don't know what the difference between the last two big ones and the next big one will be, but they all have to be Fibonacci ratios of each other, one higher than the other, higher than the other, higher than the other, till it doesn't matter anymore. Anyway, everybody's expecting some big stimulus out of China, big stimulus out of the EU, and an easing by the Fed. So this global move towards making everything easy continues. And again, the bond market's going negative, make corporate debt very low cost to get. So lots of corporations are willing to sign up for these low interest rates. The real problem is where do they go from here? Okay, so with that, I just want to mention before we take a quick break here, I do a couple of shows coming up. I've got one in San Francisco on September 14th at the Golden Gate University, and you're more than welcome to sign up for that one. It's at TSAASF, and you can go check that out. Also, I'm in Toronto at the Money Show, the 2021, September 2021. So if that could work, and I'm going to make an appearance, not speaking, but at the CMT Association meeting in Minneapolis on, I believe it's the 17th, the Tuesday night. So with all of that coming up, got lots of things that I'm out and about doing, and I'd be happy if you could introduce yourself if you're able to make it to any of those functions. We're going to break away for a commercial, and then we're going to come back and talk about the oil business, and I'll explain why in a second.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have Chart School and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Okay, we're back, and I want to start here with Schlumberger and Halliburton, and the reason is these charts are ugly, and I think the big thing that we need to be aware of, a couple of things showed up this morning in my in-basket that made me want to talk about this. And one of the things was that this article up at the top here is titled, "Is Global Crude Oil Production Falling Faster Than Global Demand?" And we have two real important things going on here. One is that as oil prices stay low, all of the mega projects that Shell and Exxon and BP and Total and those kind of companies would embark on, they have significantly slowed their growth curve on them. And what you see far out on the horizon is that these projects that take 10 and 20 years to build. So one of the things I always like to talk about is a car factory is, considered a big investment, and it's $4, $5, $6 billion. An oil facility, some of the extraction facilities and offshore wells and production facilities can be 20 or 25 billion, and they can literally power an economy for 3 or 4 or 5 years. And so when just through the construction phase alone, and those are huge investments that somebody has to sign off on. Well, with the low price of oil, the high environmental risk, the governments wanting to increase their tax share, a lot of these projects aren't going forward. And so while everything seems rosy today, we're getting to this point where as these big projects aren't coming on and the depletion rates of the existing stuff does show up, then we end up having this inflection point. And we aren't here today, but the reason I bring it up is with the Iran sanctions and with Venezuelan sanctions, both of those countries are kind of out of the market, and so that does tighten up the supply of crude globally. And then the second component to that is if one of those countries is going to come back on stream, let's say Venezuela gets resolved peacefully, then what we'd have is this situation where we have more crude than we need for now. And so either Saudi would restrict crude supply, or the OPEC members would restrict crude supply, and that would bring supply back into balance. But eventually, over the next 3 to 5 years, we're going to have this situation where we actually have a severe long-term cycle shortage of crude oil, and that will obviously flow money into the wells. But the point that we're at now is that these charts all look really ugly, and it just makes for an interesting thing to keep watch for, to see if these charts are going to start to turn. I looked at the Concho Resources report, and Concho is, here, let's just go get the chart. CXO is the ticker symbol. And what we see here on this report, it's been middling sideways for a couple of weeks. This chart right here is when they announced earnings, and they announced that they were going to slow their drilling activity a little bit. And if you look at this on a big picture, so this chart goes back 2-3 years, and you can see that's a bit of a drop. But if we click on this chart and just extend out the window, what we see here is this chart's, breaking to new 10-year lows or 9-year lows. And this huge move down is as a result of the reservoirs they're in having high decline rates, and they've decided to slow their drilling program. And so what happens, what we mean by a high decline rate, is if you imagine a well that you drill and you get a sudden surge of oil, that's all excellent. And then as the well produces, not as much oil flows back to the well, and so you get a lot lower production. Well, on these long horizontal wells, and this is an incredibly interesting, they said some of their runs now are, their average for last project was 4,400 feet, and their new ones were up in the 9,900 feet, this one down here. An average lateral length of almost 10,000 feet. So you could see they're going 2 miles horizontally, and what happens is you get this initial surge of oil, huge, because you're bringing in 2 miles of oil all at the same time. And then as that pressure quickly drops, it all depletes out. And then the second thing that they announced in here was that they found that they were testing their spacing of all of these wells. And what they found was in this Dominator project, they had their well spacing was too tight. So they had put them too close together to try and get more oil. And what basically, they were so close to the other line that they didn't get enough oil out of each one. So as the project rolls forward, they talk about what they're going to do. And one of the things they said was, up here in the very top, 329 million barrels of oil a day or something like that. Yeah, 329 barrels of oil per day. And their expectation coming up was for less than that. So not even keeping up, but actually producing less. So as these new wells come on stream, they're unable to produce enough oil to keep up with the growth rate that they had. And Shell and Exxon talked about this years ago, that these shale projects were too tight. And what would happen is you'd have high initial production, but the decline rates are so fast that you'd literally need a parabolic advance in the number of wells to keep up with your decline rates to show a growth in production. So early on, you have a lot of growth and everything is fine. And then as you start to drill out the reservoir, you would need a lot more wells just to keep up with the very rapid decline rates you had on the wells that you drilled last year and then wells you drilled 6 months ago. And so you have to keep expanding that. And so the moment Concho said that they weren't going to stay in that race, their stock did this. And so they were $160. They're at $60. This is a 70% decline in under 9 months or 10 months. So with that rapid change in perspective from one of the companies in the US, you can see how quickly the problem would start. Is all of a sudden the growth rates that we were on, we're not on anymore. And we're going to be looking for the companies that still have some sort of growth rate. But the bigger issue is if we don't have that growth rate, then eventually we get to this crude crunch. And so that's kind of the reason that I wanted to bring up the oil and gas companies this morning. So I mentioned that the emerging markets, um, when we look at the emerging markets, they are closely tied to commodities. And so if they don't improve, we probably don't have any commodity improvement. But you can see this big downhill slide here on the emerging markets compared to the S&P 500. And if that would start to improve, that would be pretty good news. And you can see back here, all through that 2017, 2018 period when the US markets were rocking, the emerging market was actually slightly outperforming the S&P 500. And this big up ramp was really, really bullish. And globally, everything was doing well. And maybe I should just put the SPY on there so everybody, in case they're not in tune, can see the history. Okay, so what we've got here is we had a big up ramp in 2018, and then sideways while emerging markets were kind of underperforming. And to me, emerging markets, a lot of their wealth comes from commodities that they supply to the advanced countries or advanced economies. And so what we see here is as long as emerging markets aren't doing well, neither are the US markets. And I say that very lightly because we just went through PayPal and all of those stocks, and they've been rocking and rolling for quite a while. But the big picture to me is if all of a sudden we start to see this as a false breakdown in the emerging markets and turn higher, and we have these PPO declines, and all of a sudden we start to break to the upside here with more stimulus from Europe, more stimulus from China, and China's considered an emerging market. Obviously, still doing very well as an economy with a growth rate up around 6%, but apparently it's not fast enough, and they got to ramp that even more. You see all of these government efforts to kind of push the thing higher. And so if that's going to go on, then this might be a sweet time to start looking into the oil business. And when we look at the daily charts here, again, these charts have been just precipitously declining, and eventually they reach kind of a gasp moment. But here we are in April at $32 for Halliburton. It's at 18. That's a 50% decline in just a few months. And if we go back, over a year ago, this was a $53 stock to 17. This is a 70% decline. These ones over here are just getting taken out to the woodshed. And the one point I would say is, we're starting to get higher lows in momentum here, not here. But I would draw a trend line across these momentum trends. And if they start to break, they'd be worthwhile participating in. And it's because of that oversold nature, all of the governments worldwide all of a sudden starting to do an easing program, that we might get another shot in the arm like we got back in 2012, 2013, where everybody said, more quantitative easing, please. And the world moved forward with stimulus to try and get this thing rolling. And so rather than the U.S. pulling back, we would see that return to corporate growth worldwide is what would try to happen from the central banks. Now, again, the central banks just happen to be having a party together. Actually, it's a meeting, but they're in Jackson Hole once a year, and it's this weekend coming up. August 22nd to 24th, starts tomorrow. And so with that, what we're going to find out, they don't usually announce anything there, but they all go back, and then when they do their policy announcements in September, magically they come out and say, gee, we've come up with this idea. And part of the idea is that we're going to introduce stimulus. And so Europe does it. And then all of a sudden we get something out of China, and we get something out of Japan, and we get something out of South Korea. And all of these markets try to get things running. And if that's the case, then we might see this bounce in oil. Now, again, I'm not trying to be prophetic about where oil's going. It's literally a wait and see. But when we look at some of these charts, so this top one here is a Russian chart, but this Par Pacific, that chart's been working up and to the right. Here's Cosmos Energy, and you could just see it sideways. And I don't know anything about these companies. I'm looking merely at the price action on the charts and what investors are thinking. When we look here, we can see this is sitting at 650, and a breakthrough to $7 would be pretty important. Here's Hess, and this chart looks really good, right? A breakout to $65 through $65 would be a pretty excellent spot to get involved. You've got nice horizontal support resistance. It's breaking out, and it wouldn't take much to get to new 6-month highs. Here's Sunoco, and what we see on this one is it's been pushed up and then pulled back to support, and breakout from here above $30 would be nice. This Tellurian, this one has long been was for a long time a Kramer favorite. I don't know if it still is, but you can see that this big chart is pushing all the way down, got below $5 and is already back up to 8. That's up 60% since the beginning of the month. Looking at Bonanza Creek, this chart isn't too bad, but I've sorted them here on scooter ranking, and as you can see, they're all deathly in the ugly zone. You want them to be above 50 at a minimum, and you'd like them to be moving through 75. But that would be my point. Start to watch this list, and if they start to break out above 75, that gives you the opportunity to start farming some of these charts. And Crescent Point Energy is in Canada, but they have wells that reach into the U.S. Bakken up in Montana and North Dakota. So with that, they're sitting right here at a $3 chart price, and huge slide from 650 down to $3. Quite frankly, a nice base has been built here, and any sort of a breakout might be a nice opportunity. Looking in on Phillips 66, that chart's moving up and to the right, unlike most of the oil companies, and so that's probably another place to look at. Comstock, Noble Energy, this is another one. It's grinding sideways for the last 2 months while the price of oil and a lot of these stocks have been getting bombed out. So something's going on here that it's trying to hold its lows. And if it starts to actually make advances, that would be good. Cenovus has a refinery in the U.S. They do a lot of production in Canada. They've been getting their balance sheet in order since they bought a lot of this, I think it was Chevron assets in Canada, but they're trying to get going here. And you could just see that there's an upslope there from the December low to the May low to the August low so far. And any breakout to the upside, I think, could probably help. So a lot of these companies are starting to be in a position that at least you can start to look through the charts and see some bases being built. And the one thing that's drawn me to the charts this week is all of a sudden I've seen a whole bunch of stocks move 12, 13% in a couple of days off really, really big lows. So either somebody's stepping in to buy the stock on the lows, or the actual company itself is starting to buy the stock down here to take control of it. And again, just as you work through, I'm not trying to be prophetic or pick the lows. I'm just saying a lot of these charts are bombed out. And if you're trying to look for something that would start to pick up, these charts could move up dramatically in a few weeks and months just to get back to where they started. Anyway, my encouragement would be to set up a chart list of exploration and production companies and roll through it. And when you do that, I think you'll find that it's an easier way to farm this list to see if there's something going on there. So I want to say thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. And if you get the chance, head over to StockCharts YouTube, and you can find my weekend market report on the Canadian Technician channel there. Thanks. Bye-bye.